Everywhere you look, there are headlines screaming that the real estate market is about to collapse, citing that homes are overpriced, they're unaffordable, and they're sitting on the market for too long.
New data from the Wall Street Journal is showing a massive collapse in home buyer demand.
January's real estate market data didn't do a lot to dispute the screams, as inventory, price cuts, and days on market all increased. Personally, as a top 200 lender in the United States, just this week, I've had conversations with sellers sharing that they feel a need to sell now before the market crashes, and with buyers who are struggling, deciding if they should wait a little longer. These attention-grabbing headlines make for compelling content, there's no doubt, and soft data can give you pause. But is a bubble really about to burst? Let's dive in to an evidence-based analysis of where the housing market actually stands right now in early 2025. The key to assessing market stability lies in examining core fundamentals and fact-based data rather than following dramatic clickbait predictions. And if you've spent any time on YouTube, you've probably come across a number of crash bros, such as Nick Gurley and Michael Bornero. Nick's content is practically a crash countdown, constant claims that we're on the brink of another 2008 style meltdown. But here's the thing, Nick's been making these same predictions for years. And many people who follow his advice missed out on building equity wealth and locking in historically low mortgage rates. The truth is, doom and gloom content grabs attention and builds profitable channels, but that doesn't make the predictions accurate. Three critical factors shape today's market dynamics, starting with the supply and demand balance. Current inventory levels, while higher in specific markets, is historically low nationwide, creating a natural price floor. Despite higher interest rates dampening buyer enthusiasm, the fundamental shortage of available homes continues to support market stability. New construction, meanwhile, hasn't been able to keep pace with population growth, with Zillow still estimating the U.S. housing market is short by 4.5 million homes. Current pressure on the cost to build a new home will continue to maintain pressure on existing housing stock. Another crucial factor is homeowner financial health. Unlike the 2008 crisis, today's homeowners are in a much stronger position. Strict lending standards implemented after the last crash have resulted in a more resilient borrower pool, evidenced by the near record lows for both mortgage delinquencies and foreclosures. Plus, most homeowners today have substantial equity, reaching nearly $35 trillion in 2024, resulting in an incredibly safe and low 31% loan-to-value nationwide. This provides an equity cushion against market fluctuations and reduces foreclosure risks. Now, there are conversations around higher credit card and student loan debt. However, this is disparagingly affecting renters over homeowners. The broader economic context also plays a vital role, primarily with the labor market remaining incredibly resilient. Unemployment is up slightly from 2023, but has stayed flat for the last 8 months. Wages dropped from their pandemic peak, but have had a hard time breaking below a strong 4% annual growth rate, with job gains remaining consistent and initial jobless claims remaining at a 10-month low. A resilient labor market and economy creates the foundation for a stable housing market. While affordability challenges are real, they typically lead to market adjustments rather than catastrophic collapses. Real estate traditionally moves through predictable cycles, but external forces can disrupt these patterns. The pandemic created unprecedented market conditions that we're still processing. The combination of record low interest rates drove exceptional price appreciation, while remote work sparked migration patterns that reshaped local markets. Government interventions altered normal market mechanics in ways we're still understanding. As these unusual factors normalize, we're seeing expected adjustments, but these should not be confused with a market crash. National trends provide context. but real estate remains intensely local. Some markets are experiencing price corrections, while others maintain steady appreciation. The variations in market performance are driven by regional economic strength, population movement patterns, and local building regulations. Housing supply elasticity in different regions creates distinct market dynamics that can't be captured in a national headline or broad predictions. For long-term homeowners and investors, current market conditions present both challenges and opportunities. While the era of rapid appreciation, thankfully, may be pausing, fundamental factors supporting housing values remain intact. Population growth continues to drive housing demand across many regions, while higher construction costs maintain upward pressure on home values. The persistent scarcity of land in desirable areas also provides additional support for price stability over the long term. Remember, while there are short-term corrections in home prices, long-term home values always goes up. Rather than a dramatic crash of a housing bust proportions, market indicators suggest a period of normalization. In some markets, slight softening. We can expect to see more negotiating opportunities between buyers and sellers right now, with longer selling timelines becoming more normal. Price growth is likely to moderate, slowly returning to historical averages. This particular housing market, with more recent inventory, less buyer competition, and slow price growth, is exactly what buyers have been waiting for. In my home state of Colorado, Denver closed home prices saw a very moderate 2% home price growth in 2024 and has started 2025 up 1.77% year over year. Over the long term, however, Denver's strong demand, restricted housing supply, and steady population growth are expected to support a modest price appreciation. In 2025, we're only expecting 0 to 3% growth rate. The key is understanding that these changes represent a return to traditional market dynamics rather than a systemic failure. Ultimately, your housing decisions should reflect your personal circumstances rather than market timing speculation. The most successful real estate decisions typically arise from careful consideration of your long-term housing needs, your financial readiness for home ownership, and the local market conditions. Personal risk tolerance also plays a crucial role in determining the right time to enter or exit the market. And these factors matter far more than trying to time market cycles or react to those dramatic headlines and predictions. While dramatic market crash predictions may generate clicks and views, they often oversimplify complex market dynamics. Today's housing market faces challenges, but the fundamental factors supporting stability and long-term wealth creation remain intact. Focus on your personal housing needs and financial situation rather than dramatic headlines when making real estate decisions. Real estate success typically comes from patient, well-researched decisions, not reactive moves based on unsubstantiated market predictions. Whether you're considering buying, selling, or holding, let me know in the comments below. I'm Nicole Ruth, your trusted mortgage advisor and real estate expert, helping you build wealth through home ownership, one smart, educated decision at a time. And hey, don't forget to like, subscribe, and share this video with someone who's looking at buying a home or investment in today's market. I'll see you on the next video.